Good morning. This is Jim Riggio. Today is Monday, June 19th, and this is the Monday Market Muse. Quick disclaimer before we get started. Capital Discussion is not a broker-dealer or investment advisor. Presentation about to see is for educational purposes only. We have no way of knowing what level of risk is appropriate for you. We're not making any trade recommendations. Risk of trading options can be substantial. Please be aware of all risks prior to placing any trades. Any trades that we discuss here are believed to end up being accurate. However, such things as slippage, commissions, and liquidity could change your P&L. Okay, and with that, let's get started. One of the things that I always take a look at, and I wanted to start this morning with this, the market's up pretty big. We've had a rather significant range last week during the day, but hardly any movement at all afterwards. Meaning that from a day-to-day perspective, things had really not changed very much. The selling had really been confined and led by FANG plus M, right? It was really Facebook, Amazon, Apple, Google, Netflix, and Microsoft, and the other larger technology companies. Curtis, I don't know if you're still trading the NDX these days, but man, you've had some excitement over the last couple of weeks, haven't you?
Yeah, I'm not in it. It's just too hard.
Good. It's the thing. When I ended up seeing that, immediately, I ended up thinking about you. One of the things that I wanted to end up showing this morning, and I'm going to get into the range, but this was something that ended up happening, pretty much this morning, is that we've had this big drop over the last, I'd say, two days plus also this morning in the VIX, where we had a little bit of movement upward, okay, and that's what you're looking in the candles here, is the VIX movement higher. But much more importantly, from our perspective, I think, is that you need to take a look at the VIX futures. For those of you who haven't seen this chart before, basically what I've done is that I've mapped out the VIX futures in close to the color of the rainbow here, where the blue is the shorter term, the red is the longer term. So we're basically looking at starting in, if I double click on here, you can end up seeing this is the M contract. For those of you who don't know it, that's the June contract where it's going to be expiring in a few days. And moving forward, okay, you're looking at June, July, August, September, and October. And so what we tend to take a look at is on these graphs, we like to see a nice slow and gradual decline of each of the futures, with the front month declining at a faster rate than the back months. When you have a nice separation between each of the months like we do here, okay, that's known as contango, and that usually means that the market is in relatively decent shape. One of the things that I want to end up pointing out, not last Friday, but the Friday before, is that even though we had this very, very big spike in the VIX, if you take a look at the difference between the VIX futures, yes, it narrowed. It definitely narrowed the distance between the two, but they never even came close to touching. Okay, and these two, by the way, are the front month, which is the June, and the second month, which is the July VIX contracts. As a way to kind of end up seeing them a little bit easier, what I've drawn here is basically the difference. So let me end up I have to end up doing this here. Okay, so I want to show you this blue line, which is basically the VIX contract, okay, with the letter N, which is July, minus the June contract. So basically we're looking at the difference between month 2 minus month 1. And so this is the contango factor. And what I wanted to end up showing, okay, this morning is that it's been getting larger. It's actually been getting larger since, we had our little spike last week here, and you can see that since it's getting larger, that basically means that the market is in a very comfortable mode at this point. And so this is many times, and if I highlight this, okay, you can see that this ended up happening basically, right off of the opening. And so when you see the VIX futures get into further contango, that usually means that there's going to be more upward pressure on the market than downward pressure. Which was a very important thing, I believe, considering what had happened over the last couple of weeks. Let me show you the graph that I put out on the Vol Vantage trade pretty much every morning. I want to end up showing you. What I basically do is I take a look at daily channels, and if we end up having any type of movement where we're breaking out of ranges, you can see that a couple of weeks ago, and what you're looking at, just so that you can see this here, is you're looking at a 15-day 5-minute chart. Where I basically have highlighted the tops of the ranges in this aqua blue and the bottom of the daily ranges in this orange color. When we end up having significant sideways movement for multiple days, I will end up pointing that out in a sideways channel. So this was the sideways channel we had right up until not this past Friday, but a week ago this past Friday, where we ended up breaking out of the range to the upside on on Friday morning, only to sell off really, really hard, and then to end up bouncing back so that there was, we were still in the middle of the range. The reason why the graph has been pushed up 3 points is because we had rolled the active SPX or E-mini contract from the June contract to the September contract. And there's about a $3 difference in the price, so I ended up just rolling everything higher. On Monday, okay, you can see last week when we were talking, we were significantly below and had a sell-off below the center line. Okay, the center line being basically on Friday's close. You can then see on Tuesday and Wednesday we ended up moving up. This was a very interesting little bounce that we had on Wednesday. It was during the Fed Yellen speech. And even though we've had some pretty big ranges, like take a look at we closed here on Wednesday. On Thursday, we opened lower, went lower, and then closed only a couple of points high, lower than where we were. And so what's happened, if you're looking at just the daily changes, you're not seeing a lot of big differences. You haven't seen really very much movement at all when it comes to the daily movement. But what's happening is you can see that the ranges during the day have gotten much bigger. When you get these larger daily moves, many, many times they can end up being a precursor to the markets making very, very large moves to end up breaking out. If we end up taking a look at the longer term graphs, okay, and let me go back, and for those of you who are new, okay, you can end up seeing the long-term trend or channel that we had that started pretty much at the end of 2015, and we had moved up, okay, quite significantly over the last year and a half. There were a few times, you can see here when we had the big breakout in February, where we got above the channel only to come back into it. And you can see that we've been flirting with the top end of the channel again. We were getting to a crossroads here where we had the long-term channel in the aqua color that would have been moving up but at a slower rate than the support line that we had drawn from the beginning of this year. If you take a look at the last day of trading in 2016, you can see how cleanly the trend line was supporting the move up in January until we had the big break up in mid-February. You can also see that when we came down, it ended up acting as support. Even when we were able to get below it for a few days, when we broke above it, we broke above it in a big way. You can end up seeing that more recently, after we had the big sell-off on the 17th of May, that we've continued to end up moving up. Once we got above it, it has acted as support, even though we've during the intraday markets have closed below it. During the intraday markets, we have been below it. We have closed above it, and now we have another move up, and we've created a gap this morning. And so the markets look relatively strong, and in some ways, when you have this type of a movement, okay, like over here, Sometimes they're called blow-off tops. Sometimes they're called exhaustion gaps. But I don't know if this one appears that we've had another exhaustion gap. But when you leave a gap like this, it's very, very, very frequently these types of gaps don't end up holding. They tend to end up filling at some point in the future. Sometimes, like this, it takes a week, sometimes it takes a day, sometimes it can take a very long period of time. If I show you, and this will be the last graph that I end up showing you before we kind of end up opening it up and we have a conversation. Um, if I show you the longer term graph, okay, I want to show you a couple of gaps that we had in 2016. These are the types of gaps that sometimes will remain. It's when we end up having a very, very strong sell off, only to have a very quick rebound. And the gap is an area where we've had a lot of traffic or support or resistance before. And so, since the selling came through it very quickly, the gap on the way up sometimes tends not to fill. However, if I end up showing you, and we've talked a lot about these types of gaps where we've been running sideways and then we move up, these types of gaps right here, this one filled, right? These two over here, where we had two in a row that ended up moving up pretty significantly, they filled over here. This gap filled, this gap filled. And so for us to end up running uninterrupted from this point higher, I think is kind of unrealistic. Now, when you take a look at this gap, look at, and this is a good example. How quickly does this happen? Um, I thought for sure this gap was going to fill, and I did not end up reducing my position or dealing with my deltas, and we gapped again the next day, and then it took approximately 3 weeks before we actually did fill the gap. But if you can see that even once we ended up gapping once, gapping twice, we did end up continuing to move sideways to higher before we ended up having the hard sell-off on the 17th. And so the timing of it is going to be difficult. But when you take a look at where we are and what's moving forward right now, the market is very, very strong. I know that we ended up saying this is the last graph, but I do want to end up talking about how things end up looking with the FANG plus M stocks, because when we've talked about them in the past, what's happened with them is that they've driven the NASDAQ rather significantly. Okay, and here was that index. Let me just get rid of the, we don't need the international stuff here. Okay. What you're looking at here in the white line, and you can see it right up here, here's the NDX. And so the NDX from basically, a couple of weeks after the U.S. elections has just ended up been on an absolute tear, much, much higher. This entire sell-off that we see during last Friday, a week ago on Friday, and also we were weak towards the end of the week last week. This was driven mainly by the largest capitalized stocks within the S&P. I'm sorry, within the Nasdaq. When you take a look at, I know it made news right after the U.S. election how much the RUT and the small caps did after the election. You can see that they've moved sideways and they've underperformed basically since early December, whereas the S&P and the Dow Jones have kind of been in the middle. And here's what I wanted you to end up seeing. I'm just going to go through the FANG stocks real quick. If we take a look at Netflix, you can see that it was even above the NASDAQ line. And here was the big sell-off that they end up having. Let's take a look at the A's, Apple. Help if I could type. Again, right, a lot of the outperformance belonged to Apple. And you can see that it ended up being a big piece of the sell-off that we had last Friday. And also last week, it took a look on Wednesday, Thursday, Friday. The selling continued. Take a look at Amazon. Okay. Again, it was a big part of the selling, but it recovered everything and then some. Although, even though it opened up so highly, it's been a little bit weaker today. Uh, I started with Netflix, and I should have started with Facebook. Would help if I could spell Fang, huh? Same thing with Facebook, and then the last two would be Google again, right? Participated very much in the outperformance, especially in some of the larger gaps that it ended up having. Okay, around earnings, big part of the sell-off, and is increasing today. And then lastly, Microsoft. Um, Microsoft had not performed as well as everything else, but you can end up seeing in the big run up that it had in the late May move, it definitely ended up showing outperformance from late April through the beginning of June, and it was part of the big sell-off also. So these are the six or so stocks that I think that we really need to end up watching. Um, they've been positive today, and the market ended up moving higher. If they're selling, ended up spreading, it could end up leading to much wider selling across industries, across sectors. And the thing that's scary about that is that we're very much in a news driven environment. The economy has slowed down a little bit. There's increasing political unrest, and the implied volatility is extremely low. And with the implied volatility extremely low, that means that there's not nearly as much protection to the downside in places that you would end up thinking. However, because the put skew has remained relatively steep, any buying of options, okay, that would increase implied volatility has basically all been done below the money. So it's not, the low IV is not as bad as would generally be perceived because of the steepness of the put skew. Okay,
The market
that
the market's
go
going
ahead.
up so fast that any puts you buy are become deep out of the money pretty quickly.
It is true. Okay, it is true. It's a when it comes to how to end up protecting an environment like this, um, probably some of the best ways if you need to end up buying downside protection is not to actually end up buying below the money puts, but to buy wide put spreads. Buy something closer to money and then sell something far below it. And the reason why that makes so much sense is let me take to be able to end up showing you that. Okay, so if we take a look at the SPX, and let me just get rid of this stuff over here. Okay, so when you take a look at, and let me take a look at something where I don't have anything. Let's take a look at something maybe around 30 days out, 28 days out. So what ends up happening is that if you're going to end up buying a put spread for some type of protection, buying something closer to the money where you can pay a 7 or an 8 implied volatility and then selling a 14 or a 15, okay, you're buying a much lower IV and selling a much higher IV. So this will end up giving you a fair bit of protection, and you're usually better off buying something that ends up giving you that level of that level of edge where you're buying a low IV and selling a high IV, which ends up making a lot of sense. The other thing you can end up also doing, okay, to be able to protect your downside, is to do the same thing in the VIX, but in the VIX, do it in something where you end up having a call spread. Here, you're going to be even more dramatic. Okay. Now, the problem with buying a VIX call spread is that it's nice to end up doing when you end up having a VIX that's around 10. Okay. Right now the VIX is at 1009, but you know that these things really end up pricing off of the VIX futures. but the VIX futures have been selling off too, right? The front month, which is going to expire in a couple of days, is at 1075, and the next month VIX futures is at 1190, and so that's a pretty big difference, right? I mean, here, if I end up, oh, not that one either, over here, and this was the VIX term structure. Okay, so when you take a look at the front month and the VIX, you now have to end up converging. Okay, eventually, right? They must end up converging. Okay, upon expiration. And so when you take a look at the Junes and versus say the Julys, if I go out 1 month, you can see that the 1 month, okay, VIX futures are close to almost 2 points higher than the spot VIX price. And so the challenge with a lot of these things that even if you wanted to end up buying a VIX spread on something like this, remember the center point on here, if you will, the in and the out of money is going to end up really being 1190. And so now you would end up taking a look at, well, how high do you think it would end up getting? And you can end up buying a VIX vertical, rather inexpensively. What I've done, if I've been fearful that there's going to end up being a spike in the VIX, I'll end up buying, maybe a, 7-8 point wide vertical. Let me end up showing you this over here for a sec. If we do something like this, we end up buying a vertical. And how far out do you think it'll end up getting to? What I tend to end up doing is that I'll take a look and see when do we end up dropping, by less than a certain amount of money. The way I'll end up looking at this many times is that instead of looking at, let me make this totally big so it doesn't end up having stuff behind it. Instead of looking at just single strikes, what I'll do sometimes is I'll look at verticals. And now what I'll do is that I'll come down and I'll take a look at the market, okay, price of these things. And maybe what I'll do is that I'll stop once we end up getting to, let's say, a nickel. Okay, I want to get at least a nickel to end up going up another dollar. So if you take a look at that, maybe that's 20 or 21. So what I'll take a look at sometimes is doing something like this at 85 cents. And this is to end up hedging, not for the market to end up coming down 1 or 2%. This is to end up hedging if the stock market ends up having an ugly day where we go down 2% one day and 2% another day. At that point, you'll see the VIX really end up jumping. Okay. And depending on what ends up happening, I've done this trade a bunch of times. And here's the problem with any of these things. It's timing, because you know that if you hold this thing long enough, what's happened over the last probably, 6 years, 7 years, is that the VIX will end up spiking and then it'll float back down.
Trading connection
right? When
lost.
you take a look at that chart that we ended up having of this, if I
Market
do the
data
following, let me just
connection
get rid of
lost.
all studies for a second here. And then instead of taking a look at a 15-minute chart, let's go back. You can see that any kind of spike that we've had, okay, has basically come down very
Trading
quickly.
connection
Even if you go
re-established.
back to the spikes
Market
that
data
had,
connection
some real
re-established.
teeth in it, right? Going into the U.S. election, going into Brexit. I'm sorry, this one was Brexit. Going into some of the selling that we had in September. If you take a look at the selling that we had, a year and a half ago, yeah, we've moved higher, but we've also moved back down pretty quickly. So you can't just put on a VIX vertical and think, okay, I'm done. I don't need to do anything. You have to be very, very diligent, and you have to end up working on your timing on where do you think it can end up spiking. Do you think we're going to spike up to 16? Do you think we're going to spike up to 20? I've been working off the assumption that for us to get above 16, things have to end up, the fear has to be really, really high. And at that point, things could end up changing significantly. So what I've done is that, and I've done this a couple of times, if the market ends up running at this point, and you get up to 14, 15, 16 on the VIX, naturally the futures will be a little bit higher. What I've done is then I've converted this into like a condor. And the way I've converted it into a condor is the following. What I would end up doing is something like, if I think that we're going to get back below 15, right, do something like, then by something that now, granted, it's going to be much more expensive at this point, but if you do something like this when we end up jumping, okay, not even 25, if you go to 23, okay, or 22, okay, what will end up happening is that this spread will end up jumping sometimes from, if we go from, 1075 and we jump up to 14, this spread might go up to, a buck
Market
50.
data connection
Okay.
reestablished.
And if you end up, when you end up, now this is if you think it's going to come back down. Now I have a structure like this. And I think that it's a way to end up playing this sell-off that we've had. And if the market just continues, right, to end up selling off, and you're fearful that it's going to get much worse, you can end up being here. This is a very different trade than if you did it in the SPX, right, where if you wanted to end up hedging the downside, and we did something like buying, and let's do something a little bit further out. Let me just go to, say, 46 days. Let me get rid of the verticals, the singles. Okay, where you don't have quite the same steepness, and so it depends on how long are you looking to protect for. You don't have to protect in the same amounts. Like, for example, if you're fearful that, within the next 3 weeks we're going to end up having something where we're going to end up dropping rather significantly, one of the things you can end up taking a look at is going over whatever time frame you think would end up being appropriate for you, for what you're hedging. Don't need 75 strikes here, by the way. I'm rolling too much. Let's go down to 50. And you take a look at something like this, for example. Maybe we end up going from, and it's to the level that you think, maybe you think that if we go down, we're not going to go down below 2,400. Okay. And not that we're not going to go below 2,400, but if you take a look at that, the implied volatility is a little bit higher versus if you wanted to end up having even more protection, maybe you end up going down, 100 points. Now, remember, one of the things that ends up happening many times when we have these types of sell-offs, what will end up happening is that we'll end up having a rather large move, and implied volatility will go up. What we used to end up thinking that would always end up happening would be that the implied volatility that would be near the money, by the way, if we went down 50 points, okay, this would be near the money, not this anymore, right? Because we'd slide down, okay, the scale here. We would end up thinking that the implied volatilities above and close to the money would increase much more than the implied volatilities below the money. And the answer is, well, it depends. Like, I'll give you an example. Last week, when it was rumored that the special counsel was going to be investigating Trump, okay, volatility jumped, and we ended up having a bit of a sell-off. Now, on something like that, I don't know about you, but I'm and I've shared this with you, right? I'm not registered with either party, never have been. And I kind of looked at this after Comey's testimony. The special counsel was put in place to take a look at what was going on with Russia. I don't know how he wasn't going to end up investigating Trump. So when it was rumored that the special investigator was going to end up directly investigating Trump, it was like, okay, he's doing his job, is the way I took it. But, the news cycles made such a big deal about it that it implied volatility did jump. It did throw fear into the market, but not for the little bit of drop that we ended up having in the market. But the fear would be what would happen if. And so if you move down on fear that something might end up happening, but that vent still isn't there. What happens in cases like this is that the put skew doesn't get flat, it stays steep. So what ends up happening is, yes, these implied volatilities might go up 2, 3%, but these might go up 3 or 4%. So the steepness or the angle of the steepness ends up staying there. Okay, and so how do you end up managing something like that when you end up buying something out of the money? Okay, and some of the out of the money put spreads are really, really cheap. Like for example, if I wanted to end up buying 100 points, a 100 point wide spread from 2400 to 2300, it's a 100 point wide spread for $7. So if you're looking to protect against something that could, be disastrous, I think that this is the type of thing you want to take a look at, because here's what the market has been telling me. Okay, in terms of looking at the elephant footprints, looking at all of the implied volatility, one of two things ends up happening. Either we continue to end up moving the way we are, but if we end up moving down, I fear that we're not going to move down a little bit, we're going to move down a lot. I think the probability is that we keep moving higher. Okay, the thing is that every bit of selling. Okay, I was worried a little bit about the selling in the fangs, but you saw this morning. Okay, they just continue to end up moving higher. It hasn't affected the rest of the market. But if we do have something that can't comes out major, it would end up getting ugly in a very fast way. And I wrote up a piece for the Volvantage guys this morning that the high frequency and the algo trading only makes that even worse. One of the things that's happened with the outperformance of the NDX versus the other indexes is that there's so much index investing that moves the entire market that the high frequency guys or the large money managers, if they're going to end up outperforming, they need to be able to end up outperforming in a stock where, or in a set of stocks where they could actually have the depth of market and the liquidity in those markets to be able to end up moving them. And so they're going to end up moving more naturally to the larger caps, more liquid stocks. And those were the FANGs plus M. I mean, that's what really had driven the market up. And if there's going to be heavy duty selling, you're going to see it done in the indexes, but you're also going to end up seeing it in the most liquid stocks. So this rotation, okay, is incredibly important if it does happen, because this was what ended up happening in 99, right, in 1999, which I didn't end up seeing in 1999, 2000, was that the breadth of the market, meaning the number of stocks that were going up versus the number of stocks that were going down, ended up moving rather dramatically, unbeknownst to me at the time. I learned about it afterwards. It was, a rather expensive lesson, and here, let me just show you. What you're looking at here is a daily chart, okay, going back, I guess it's what, about 6 months? No, it's a year. Going back a year. And you can see that it's just a bar chart of the advancers minus the decliners. So you see the daily range on these things. I put a 20-day moving average, and just to kind of end up giving me some like framework around which way we were moving if things were getting smaller. This is actually a Bollinger Band. And remember, the center line of a Bollinger Band is a 20-day moving average. I also looked at up volume minus down volume. Told me less unless we had very, very large moves like we ended up having, a year ago. And when we ended up having our sell-off in Brexit. But other than that, what you'll end up seeing is many times we'll end up having a bigger movement in the advancers and the decliners. When we end up having the number of decliners and the number of advancers end up changing, in the direction of the market, that
Market
becomes
data connection lost.
troublesome. So, for example, if you have the large mega cap, okay, technology
Market
stocks
data
selling
connection
off very
re-established.
heavily, okay, but everything else moving up, you'll have more decliners than you will, I'm sorry, more advancers than you will decliners. Um, if you, which is what ended up happening. What happened in '99, and what ended up happening, by the way, for a few months at the beginning of the year, is that we had our large cap stocks moving up much higher than the rest of our market, but because the advanced decline line it kept above zero for such a long period of time, it was difficult to end up for me to end up sounding any alarms. Um, but it is something that's one of the when you look under the covers of the market's important. Anyway, let me open it up. Andrew, you were starting to go through some things before. What do you think about the market, and what have you been looking at?
I'm impressed by the strength in the market. Uh, the S&P 500, on a monthly chart and a weekly chart, is in an incredibly strong bull trend, and I think the bulls are going to buy the first pullback. You look at a monthly chart of the S&P 500. The last time one month went below another month was November.
Let me come over here. I thought that this was a. Oh, long-term channel. Sorry, I kept going to the wrong one. Okay, I'm looking at the SPY here. I'm going back 20 years, and I'm looking at channels.
Yeah, I mean, look at that monthly chart. The last time a month went below the prior month was November. That's an incredible display of strength.
It is. It really is. And if you take a look at this is the again, if I end up showing you right the channel right here. This is just these were the same channels that I remember I showed you the channel, except for this is just on the SPY and it's on a monthly chart. And if you take a look at how we've just been hugging, okay, the upper channel, and even when we had the big blow off top in February, and we ended up having this was the only slightly down month we had. And look at this. We closed here in February, and we moved down, a fraction in March.
Right. And that down month only went about halfway below the prior month,
right.
halfway into the prior month.
Right. And so it's been incredibly strong. I don't have the channels drawn, right? But if I end up doing the same thing in NDX, okay. Now this is a monthly chart. Remember, this is a monthly chart. Here's the .com boom, okay, and look at what's basically happened during the last year and a half. Look at this year. I mean, it's been incredibly strong.
Yeah.
It's been incredibly strong.
That very tight channel also tells me that the bulls will buy the first pullback.
Yep. Yes.
There'll be buyers below, whatever month eventually goes below the prior month, the bulls will be buyers there.
I think that unless there is significant news, that would end up changing the way the market ends up feeling, there's little that ends up moving the market in anything but an upward fashion. I also ended up mentioning this. If you remember, when we go back to the U.S. election, okay, and here was, right, this was the weekend before this. If I end up showing you, I guess I'd have to show you in the ES, right? Because that's the only place you'd end up seeing it. Okay, let's take a look here. This is election night. Okay, we were lock limit down. We sold off huge, and being being a non-registered party member of either of our political parties, I love to poke fun of both sides, but I want you guys to end up thinking about this for a second. This huge sell-off was for fear that Donald Trump was going to be president. This big sell-off, okay, that we had on this day was fear that we were going to end up losing him as president. And so the market is very fickle. It's news driven. The market ends up reacting to news much quicker than it ever has before. And so we have the ability now to have very, very fast movements. Now, I would end up thinking that if we have news that ends up driving the market down, the economy is still, although some of the numbers were a little bit weaker. When you ended up seeing what the Fed's doing in terms of, they believe that the inflation numbers will end up being there, the wage pressure will end up moving up. We didn't end up seeing some of the inflation numbers. The Fed said because of some decrease in prices in certain areas in technology. That ended up lowering prices, especially things that are part of the CPI, things like monthly phone bills and things like that. We probably do end up having buyers step in, but the problem with it is that it gets more and more difficult because when the selling wave does come on whatever it might end up being, the market has shown that it can end up moving down very, very quickly because the high frequency guys and the algo guys. And so, and that's kind of what caused the mini crash. I'm sorry, Andrew.
I think the entire motivation for the Fed raising rates at this point is only so that they have room to lower them the next time the economy slips into recession.
Well, they need to do that. Not only that, but their accommodative policy has been accommodated for a very long time. I'm sorry, Paul.
Oh, no, that's all right. I interrupted you. How are you guys? I have a couple comments. First comment is on the Fed. They are, the only reason they're doing this is so that when she gets booted out, she can have a good historic presence at the Fed. Because as of now, she's been accused of being very slow to the trigger to
raise
do
rates.
what she's doing now. So, but I also agree that they need some, fiscally they need some room. And this is not about raising the rates. The big thing that happened this last meeting was what they're doing to their balance sheet is much more critical to the economy and the markets. Second, the market relentlessly going up. Last week, there was inflows in $30 billion inflows into the ETFs, which now brings the total amount of ETFs to greater than $3 trillion AUM. So as this money goes into these ETFs, they have to keep buying. This market's being driven to, in my opinion, some of this market's driven by what's going on with these ETFs.
Paul, I just wanted to pull this up because this is exactly what you were talking about the balance sheet, right? This is at 2 o'clock. Okay, this is when the Fed announced the interest rate hike and they made their statement. This was during Chairperson Yellen's speech, okay, where she ended up basically reiterating that they're going to start to end up reducing their balance sheet. By the way, for those of you who don't end up realizing what that means is that in quantitative easing, the Federal Reserve bought just a ton of U.S. bonds and U.S. agency bonds, U.S. agency being Fannie, Freddie Mac, Ginnie Mae stuff. And so they bought just a ton of those things, and they have them on their balance sheets. If you are a Bill Gross fan, okay, you'll end up saying, well, they're just going to end up staying there until they end up retiring. What they're doing is that when they're retiring them, meaning that if they're coming due, they're not buying any new ones, but they also end up saying that they're going to start to end up selling some of the ones that they end up having. And This was kind of a mini taper tantrum. You remember what the taper tantrum was? The taper tantrum was when the Fed said, we're not going to be buying any more bonds. This happened, whatever it was, maybe 4 or 5 years ago. The market ended up throwing a little hissy fit, and they said, okay, we'll buy some more. Over here, the economy is strong. There's no reason for the Fed to end up holding, the size of the balance sheet and as many as they've had. So they said that they're going to start to end up selling them in a very slow fashion into the market. Okay, if they start to end up selling their bonds, okay, and raising interest rates, what they're doing is exactly what I guess both Paul and Andrew said, was that they're basically getting more dry powder for next time, right? They'll have a much smaller balance sheet, so if they do need to buy again in the future, they'll be able to. Interest rates will be higher, so they won't have to buy right away. They'll be able to end up selling they'll be able to end up lowering rates before they end up having to go through another quantitative easing type of thing. And you can see that even after the market ended up selling off because they were all pissed off that the Fed isn't going to end up keeping buying, we drifted back higher, okay, through the end of the day. And if I end up going out after that, wrong direction.
Well, because the Feds have great cover right now because you have both Japan and the EU doing their easing. So there is money flowing globally. It's just not from us. Plus, the other thing, remember with the Feds cannot make a profit. So whenever, this was a big merry-go-round for them. So they get their interest payments from the Treasury. Then they would take out whatever Fed expenses there were and give the extra money back to the Treasury. So basically, all along while these treasuries and these coupon payments are being made to the Fed, the Treasury is just rotating the same amount of money around. So when they close out these bonds, the Treasury gives them the dollars for the bonds to pay them off. The Fed turns around and gives the money back to the Treasury. My guess is we're going to see that our debt the government's debt may go down once they're all done with this.
Well, they have made a ton of money, okay? And as Paul said, they haven't made the money; they've reduced the debt by it.
Right. Well,
Okay.
What they've done is they've made it so that the Treasury doesn't have to come up with the cash to pay the interest payments.
Right. Oh, by the way,
It's a brilliant plan.
One of the things that I really always truly admired about Warren Buffett is just how simple he made things, okay? When referring to the plan and how they did this, okay, and it was done underneath Bernanke actually before Yellen, and they've been doing this for a while, okay, after, the first year of doing this, Buffett said, and by the way, you also know that hedge fund managers used to be paid 2% management fee and 20% of their gains. Buffett said that if Bernanke, okay, was paid 2 and 20, I'd have him marry my daughter. Okay. So it really was a because you think about when they buy these treasuries, they bought them when nobody else wanted them. Okay, what's happening now? Okay, as interest rates going up on these things, okay, they're worth a lot more money than they used to be. Right? If I show you the ZB, let's go and take a look at this on a. Let's go over here, right? And you take a look at the buying that they've done, okay? And this, right? Because they're buying in here, okay? They're buying in here, they're buying it, right? And they're selling over here, okay? What a brilliant plan. And oh, by the way, when they bought them at such a low rate, right, at such a low price, their yield on their bonds were higher. And so it really was, a classic buying low and selling high that the Federal Reserve, you can end up saying what you want about them, but man, okay, the amount of money that they've reduced the debt by just by their quantitative easing, which was supposedly to end up helping everybody, and it did. I'm not saying it didn't, but they were also very nicely rewarded for
Well, that's what happens when you're the 8,000-pound gorilla.
it. They really are.
Yeah, right. Gorilla. The whole flock of elephants. Herd, sorry.
Hey, Curtis, I don't know if I see that you're still here. If you're not trading NDX these days, what's been going on with you?
First, let me talk about the NDX for a second. I've spent a whole lot of time back testing 7 or 8 different versions of a sort of bearish butterfly scheme for NDX, and the problem was that there was only really 1 or 2 days in any cycle that you held that position where the thing was profitable, and the rest of the time the drawdowns were tremendous. And it's one thing to back test that and wait for the sell-off, the one-day sell-off, to cash in your position. But it's another thing if, you're approaching maximum loss and you have to get out. And I had a pretty conservative maximum loss. So I had to keep taking losses and then, make it back in a month or two, and then have the drawdowns again, and it was a zero-sum situation. There wasn't any way to trade that market without a lot of chagrin and teeth gnashing, and that's a very hard way for me to trade. So I'm trading RUT M3s. I'm traveling some, so there are days when I can't get to the market. And we had a 20-point upswing in the Russell a couple of weeks ago. It was actually an SPX M3, which I also trade.
Okay.
I got in trouble because I was surfing that day, and out in California, and I'm a terrible surfer, and don't be impressed by that. It's just I was at some old beaches that I used to surf when I was a kid, and I got out there, paddled around for a while, and caught a couple of waves and came in, but it was enough so that position, is down, and I had to roll it and fix it. Because that's the best way to manage the risk in that position. Mm-hmm. And when you roll these positions, you've made some money in your call, and if you can't cash in, that there's no way to restructure the butterfly part into some kind of a broken wing butterfly below the market and take
right.
that profit out of the call, then you have to sit. I'm going to probably make some money in that thing eventually, but I'm going to have, it's a July position. I'm going to have to wait until, a week or two before expiration, for some kind of natural pullback to make the money. So I've been making money, but I haven't been making as much money.
Okay. So to kind of summarize, okay, you've been trading bearish butterflies on the NDX for years now, and what you're looking on the chart is a graph of the NDX since March of 2009, and it's you've had a hard time making money trading bearish butterflies on an index that's gone up 550%.
Yeah, that ought to tell you something. It was just too hard. I didn't lose any money, but for 18 months.
Which is when you look at this graph, that's a huge accomplishment.
Yeah, that account went from $105,000 to $104,000 in 18 months.
Okay, in 18 months. So basically, here are the 18 months. Actually, no, that's not. Yeah, that is 18 months. Is
that a monthly or?
That's a monthly chart. That's a monthly chart.
Yeah, and see, all those red candles happened one day. And if you weren't around to take advantage of it, or you waited until the next day to think you might pick up a couple more grand, you ended up taking a very reduced profit. And not making back the 10 grand you lost the month before, and having to play catch up for a couple of months. And it was just too difficult, too much work.
That's the problem. One of the things, and we don't have time to do it today, and I probably should do a separate video on it because I have done it in previous Monday Market Muses, is the distribution of returns. Meaning that if you take a look at the daily movement up or down, and then you break it into say like 100 evenly spaced buckets, and you put all of the returns into, it was down 0.5%, it was down 0.75%, it was up 0.5%, and you get this nice bell curve. What you end up seeing that over the last, 3 to 5 years, as the high frequency and the algo guys have kind of ruled the world, that we have a much flatter distribution, that at the top of the bell in the center has been pushed down, but it's moved up a little bit when it's below the market, meaning that we're still having days that, we're having a lot of days where we're not moving as much, but we're having some down days. And so it's a really, really interesting distribution, on the RUT versus everything else on the NDX. I'm basically trying to end up saying, not doing a very good job, Curtis, is that I've seen what you're paying is actually, you can prove statistically that the distribution has changed with the high frequency guys, and that when we do come down, we come down very quickly. But when we move back up, we take like the stair, and this is even more so, we take the stairs up where we go up and up and up, and then we come down, like this is a good example, right? Where you go up, 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 your ranges are small, then you come down all in a day. Okay.
Yeah.
And
that's a very hard way to trade any kind of structure that we use.
Even with that big down day, the Nasdaq is still making higher highs and higher lows.
Mm-hmm. I mean, if to me, the real test is going to be this was, if you take a look, this was like the biggest down day that they had in years. Okay, if they get back above its high, that's going to end up being absolutely, in my mind, absolutely just huge. I mean, they're still 50 points away from it, 40 points away from it. I mean, but that's the strength of the bulls is just unbelievable when it comes to this stuff.
Yeah, and I'm trying to make money. I'm not trying to prove anything. I'm just trying to make money. So,
that's a great attitude, by the way. That's the way everybody should end up thinking.
The best chance the Bears have is to make some kind of double top at the old high.
Yeah, that would be great.
Yeah, and if you take a look at the other indexes, right? If I take a look at, the problem is that there's no double top here. Okay, we're at highs again. Okay, if you take a look at the Dow Jones, right? I guess let me just put it into. Let me do. Okay, no double top here. We're also at highs. You take a look at the RUT. Okay, even though it's much slower and it hasn't had the same strength, it has been higher highs. Now, this I think is probably the single biggest tell, is that what I found from that study that I had done with guys over at EAB was that the Russell was the least influenced index from high frequency trading and algos. And by the way, think about what I just said. I mean, it's like it was so obvious, okay, when we ended up proving it, that it was like, well, duh. Think about it. If in order for you to highly frequently trade something, it needs to be frequently traded. How frequently, and what's the depth of the 2,000 stocks in the Russell versus the depth and volume of the stocks in the NASDAQ 100?
Yeah, and it's much harder to move it because of the number of stocks.
Yeah, but also the thing is that the bid and asks are much wider, and you don't have nearly the same liquidity. So therefore, actually, if there is real buying, or real selling, it's easier to move because they don't have the liquidity. Okay, and
We,
so
we've
what ends up
yeah.
happening is that we have been making higher highs, and yes, we did digest this huge bounce off of the bottom. Okay, at the U.S. election, but if you take a look at what's happened here, yes, we have been trending upward, but not at the same unbelievable pace that the other indexes have. Now, a lot of people have said, well, that's just because we're digesting this huge gain that we had here, and that's a fair point. That's a fair point. Um, but I do think that because of the wider ranges that we're seeing on a daily basis, and because of the leadership, meaning the FANG plus M, kind of rolling over last week, but they're bouncing now, that we are probably more susceptible to a market correction. Now, if we continue with the buying pressure and it goes up, it's going to be a blip and everybody's going to forget about it. And it hasn't really spread widely since a week ago Friday. So it is in the rear view mirror, and it is becoming more and more distant every day, but it's still present, okay? And we've seen that the market could sell off quickly.
That's
the
a
market is
textbook.
very strong, like you say. It's just, so we reached 2% growth, and they're talking about 3%. Is this market priced for 3% growth? I don't think we're going to get that. There will be another bounce if we get corporate tax stuff, which looks like we may not get as much personal tax as we would like. But the corporate thing, the repatriation of foreign profits is a really huge thing, and they've been talking about it since the Clinton administration. So if we get that, watch out to the upside.
Right. And so, you kind of take a look at this, and the market has moved higher on expectation that of two, I think, separate paths. One is the economy has continued to end up getting, somewhat better. Growth had been getting a little bit better, a little bit weaker than we had hoped, okay, in the most recent reports. But there is the hope that, it's going to end up continuing to get better.
But Trump said that the next GDP number is going to be shockingly good, and he would never lie.
I think it's good. Didn't he say it was going to be huge?
Okay, listen, I'm not going to have any. If you're going to make fun of stuff, you have to be very funny, like Andrew was. Okay.
Sorry.
Anyway, you do take a look at this, and the other part is. Right, so you take a look at its expectation of economy getting better, which means expectation that profits are going to get better. That's the first piece of it, first and foremost. The second part was what Curtis brought up, and it's the expectation that the government can end up doing things that would be attractive for the markets. Repatriation of taxes of foreign held money is huge, right? Absolutely huge, and it is I would consider it a handicap that U.S. companies have that foreign companies do not have. Okay, and that could end up being a really big thing for the U.S., right? Because the thing is that if that money comes back, it would come back to be invested in the U.S. or in something that would end up helping the U.S. economy. And if that ends up happening, then as Curtis said, look out, because the growth could end up getting to be really, really strong. We're already seeing some pressure on wage inflation. We were seeing some, according to Janet Yellen, right? We're seeing inflation pressure on prices, except for if you have a T-Mobile account because your bill went down. I'm being a bit facetious, but because of certain technology aspects of the CPI, it didn't moving as high, and so things could be, moving higher. It's the political unrest, I would end up saying, is probably the thing that is keeping, the potential of selling and some of the things that we had seen with markets getting a bit more volatile. And so, We've been going for just about an hour. Curtis, thank you so much for joining. Any last comments or thoughts or how you're going to be trading this market?
Not really, no. I annualize all of my thinking, so I'm looking at my annual spreadsheet. I want to make X dollars this year. How am I doing? I'm doing fine, you know. I'm probably up 45, 50% this year. It's not a spectacular year so far like 2015, but you know, I am just going to stick with what I know how to trade and where I know how to manage the risk and where I'm comfortable, so I'm not losing sleep and stuff. I'm too old. I'm not. I'm not a barracuda. You know, I'm a remora on the shark. You know, feeding off the little scraps. And as long as I have that attitude, I do pretty well.
And where's that gain? It obviously hasn't come from trading bearish butterflies on the NDX. So, what has been working for you?
Well, the M3s have been working. My SPX trade, which is a 70-day broken wing, 50 top, 60 bottom, you know, slightly below the market, 35 points below the market. That trade worked great until about 2 or 3 months ago. The structure of the SPX pricing has changed so that trade got very expensive. You know, with volatility this low, it's very hard to make money in that trade.
Yeah, and also
So,
the put skew has been rather steep, and
right.
that's been a problem. That ends up changing because that's a structure. I do a wider structure, and so it's affected me even more. So I've had to end up changing some of the way I've traded. But if you end up taking a look at
Yeah,
this
I was
one thing,
trading M3s in the SPX with 50-point wings, and you know, now it's 60 or 70, and I know a lot of people who are selling them even wider, buying them even wider.
yeah, it's challenging. Okay, going wider. Okay, if anything, I think that you have to end up going a bit narrower and putting your entire structure lower. Okay, that's one of the things I've been doing. I've had to end up changing the way I ended up trading my Kevlar, and I've been starting to use some of the adjustments that Steve and Shannon and I used to end up doing in our chain of flies. But here's what I just wanted to end up showing you real quick, Curtis, is that I don't like this number because the skew index as created by the SIBO is so far out of the money puts that it's ridiculous. They don't come into play in anything we end up doing.
Yeah.
But they've moved higher, and it's changed the entire structure of the put skew. And if you take a look, each one of these dots is a daily number going back since they started this thing in early 2011, and I put two lines on it. The yellow line is the 50-day moving average, and the red line is the 200 moving day average. And what you're seeing here is the effect of high frequency, and algo trading, where the put skew has gotten systematically higher over the last several years. And with each iteration, if you take a look at the oscillations of, when things sell off and then when they end up getting stronger again, you can see with each oscillation that the 50-day has gotten higher and higher. Okay, and so it's a pretty major thing that ends up changing the way we end up seeing the market. And in 2015, okay, you had a great year using the older strategies because skew became less throughout the year. But so far this year, we've just picked up the longer term, movement of what we had been seeing over the last 3 years before this. Okay, just visual proof of exactly what you were talking about how easy or how hard it is being able to changing things. So.
Well, it speaks to having a range of income that you want to create and managing the things that you do understand and ignoring the things that you don't understand. I've gotten tricked into listening to other people make predictions, but the only thing really that's actionable in my universe is what I think anymore. Even if it's wrong, at least I can live with it because, like for instance, that butterfly, that broken wing SPX that I was talking about, I see it getting a lot more expensive, and I know that I have to have a different trade to go to. It used to be we
Hmm.
could, when Paul and I started doing that trade a couple of years ago, you could make your money in 20 or 30 days and get out, make your profit target, because it would decay. The price of those shorts would decay so quickly, like in 2015, well, and 2016 to most extent. Uh, you can make your money really quickly, and it's nice to be out of the market. That's an old Dad Sheridan thing.
Mm.
Make me some money in 15 or 20 days and get me out. Cash is a really great position, and I can't forget that.
Oh, the thing is that what you just said, that was the single biggest key to, the trade that's made me the most money over the last, this year and the last half of last year. What was this Vol Vantage trade where I've gotten in and out of XIV or VXX. And what I've done is that in my Valvantage stuff, the biggest key that I had to end up making everything work was realizing that cash is a position. I
Yeah.
only tend to end up being long the XIV about 50% of the time. I tend to end up being long, because I'm either long the XIV, which is the inverse VIX, I'm only long the VXX, which is supposedly the VIX, about 10 to 15% of the time. And the other 35 to 40% of the time, I'm in cash.
Yeah.
And it was being in that cash that ended up changing everything for me. Okay.
I'd like to see some cash trades that you've done sometimes, just in a
Yeah.
breakdown.
Well, the thing is that in the graph that I just showed you, and you know what, I'll do another one of these things. So because if I show this one right here, I'm showing my actual trades in the account that everybody's been following. Okay, and so right now I'm long the XIV, and you can see here that my average price it was about $76 and 64 cents. If I come and I take a look at my position, no, that's not going to end up being. I thought my position. My position's up about 7% on this thing so far. And what I end up using this, Curtis, exactly what you said. I started doing a long time ago. I stopped watching the news. Okay, you don't hear Bloomberg or CNBC on the background. Unless I'm going for reality TV and comedy, I stopped watching all of the cable news networks. For comedy, every once in a while, I'll watch the same story on MSNBC and Fox, and just to end up laughing at it was like, were you guys in the same room? Okay, are you guys reporting on the same thing? But other than that, I basically I stopped reading and going through all this stuff, and I started looking at actionable evidence, or as I call them, like elephant footprints that I could end up seeing. And what I've been looking at are the VIX futures, the term structure, the skew, because I end up looking at it this way. People at pay grades far higher than you and I are the ones who are driving those things. I don't have to end up figuring everything out. I just need to end up seeing what's going on there, because the cracks in the armor will show first in things like VIX futures, VIX term structure, VIX skew. Those are the areas where things will end up happening the first, and being able to follow those things quickly. And taking action on those has proven to be, very, very profitable for me.
Well, I'd
So,
love to see, a breakdown somehow.
yeah,
I guess
you know
you
what?
can see that in TOS, but
Yeah, I'll
looking at
schedule
futures.
I'll schedule another roundtable with Tom on that. Andrew and or Paul, last thoughts or comments? What you guys are going to be doing?
Buy the
For-
dip.
When one comes, they come few and far in between. So yes.
Got to be quick.
Yeah. For the last almost 2 years, the VIX has been making lower lows and lower highs. So the first thing I'm waiting for is a change in that behavior to signal that there's a shift in the market.
Right. I think what I've been doing a lot of research on it, and I think once we get back up into the average that we're at is 12. It used to be 12 was really low, but at this point, at least 12 VIX is tradable at this point. 10 and a half just doesn't seems we struggle a lot more down here now.
Right. So you mean like?
As long as the VIX stays down there, you can make money in these trades. The problem is that you're so vulnerable to any kind of volatility spike.
Well, the other thing that I've noticed, and have had this, my brain thinks of these oddball things all the time. When the volatility is this low, there's not very much juice in these options. So some of my, I'm watching some of my friends trying to take butterflies off, and they're having to go into expiration week because there's just no money in them to begin with.
Right. You have to stay in the trade until much closer to expiration.
Right.
But as I said before, the problem is that is the market
Gamma.
going to move before you hit expiration?
And that's
Right.
the whole thing,
The
because your gamma risk
is-
becomes so huge as you get close to expiration.
Yeah.
So it's not like you're taking a lot more risk to make the same amount of money. One of the things that I used to end up saying is that I don't know if you guys remember this. Okay, if you guys ended up trading during, like, say, from 2002 through 2006, but look at what happened here. Boy, does this look familiar? Look at what's happened with the VIX. It kept getting lower and lower and lower and lower. Okay. And then, right, you guys all know what ended up happening over the next, couple of years, right?
Yeah.
So
is
yes,
it going to happen 2 years from now, or is it going to happen 2 weeks from now, or 6 years
That's
from now?
that's exactly right. I mean, the problem becomes you can't anticipate anything. You have to go with what you see in front of you.
Okay, so yes, I agree totally. And here's what ends up happening, okay, and what I've seen is that because of the dissemination of information, it's not like 1929 where things are happening, okay, and you'd find out like a year later about stuff, but information's disseminated incredibly quickly. So what Andrew said was that I need to start to see a change in the pattern. Okay, if you end up taking a look at before you had this jump, you had a change in the pattern for a full year. Okay,
Right.
where things end up starting to move. And now I'm not saying that trading at 10 VIX is still a shitload difference in trading something that's in the 20s. Okay, but
Just
it
a
was
little.
okay. There was a definite shift in the pattern. Okay, it does end up happening that you get some pretty big drops, and it will end up changing the way things. But we are in this glide path down, right? If you take a look at what happened from 2002 through to the end of 2006, beginning 2007, and you look at that glide path, and I take you over to here. I mean, we have some spikes, but we're in a glide path down. Here, at least we had some spikes. We didn't have any spikes back then. And what ends up happening, by the way, what the distribution, the distribution of return study that we did ended up showing exactly this, that many, many, many days, okay, show that the volatility should be between 10 and 12. But then you end up having a few days where you end up getting very big spikes, okay, only for the resumption of the direction to continue. That's what
why
it
you
is.
were doing this trade. Are you trying to make some cash, or are you hedging a position? That's a very different trade.
Very different trade.
Absolutely.
Very different trade. The other thing, okay, that I don't know, Chris, I know you used to end up doing, and I do, is that I still have, a cadre or a stable of, some long stocks, whether they're growth things, whether they're, interest-bearing stuff, whether they're closed-end funds that are bought at a discount. But those types of things have done incredibly well, and it's become cheaper to hedge them with a low volatility, right? The cheapest way to hedge is when you have a very, very low volatility and a steep put skew. So
if you want to buy, there's a guy in our trading group that buys nickel VIX calls like 60 days out. He doesn't, all he's doing is just tallying it up as cost of doing business, just to make himself sleep better, So if that
Yeah.
nickel, if he's got 100 of those things, he can make some money back if his positions get crushed.
He can, and here's the one reason why I'd really, think that he should look at what he's doing with that. Is the following: is that if I take a look at, and where the hell is it? I don't have it. I have to get another one. Give me 1 second. I go over here to. Bring these things down. The challenge is that if you look at 60 days out and you buy a nickel,
Hmm.
okay, look at how far you have to end up going out. You have to buy like a 36, okay,
Yeah,
and
yeah, he
so
buys 40s most of the
that,
time.
the problem with 40s is that you're actually a lot better off, okay, buying some type of a vertical, okay, than you are just that single long. I know it's going to end up being more money, but this thing maybe goes to a nickel, maybe it goes to a dime. It deteriorates so much quicker than if you end up looking at a vertical. And the reason why it's such a challenge of what he's doing is that he's buying like a 45, 50 implied volatility. I'm sorry, I'm on the wrong thing here. Because I was going to say it's much higher than that. I'm like that's way wrong. So if he's going to end up buying something like a 40 or here maybe a 35, look at what he's buying. He's buying 170, okay, implied volatility. I'd much rather see him do something like buy a 76 volatility and sell 172 volatility. That's why buying that vertical, okay, that we ended up talking about, okay, that we looked at, ends up doing a much better job of hedging. If he's looking to truly to end up doing something where he doesn't want to spend as much and he needs more, real protection of only if things absolutely get crushed. If you do something like buy, say, a 15.25, okay, it's 40 cents. And what will end up happening is that the 25 is only a dime here. So I'd rather sell like even a 20.
So,
Right. The
Jim,
thing is, though, you're going to
rem-
lose that trade most of the time anyway, whether it's the nickel or it's
Yeah,
the
you
spread.
will.
right. Well, so a nickel is at what price? 36.
Yeah.
So, let's not look at a VIX graph. Let's look at a VX graph because that's where the pricing is.
Yeah, exactly. So, right, because it prices off of this. And people forget that sometimes. Okay. So the
When was
last
the
time,
last time it was at 36?
when the government, okay, thought that they weren't going to end up paying their bills, okay, and we almost had you remember the government almost shut down, okay,
Yep.
here in 2011.
And not very long.
Right,
Not very, yeah, it was
right.
really, really quick.
And so if you're going to end up doing that, okay, the thing that actually ends up, okay, so that you don't pay as much on your theta. I mean, if you take a look at what your theta would end up being in something like this, okay, and even if I end up going back maybe to 13, okay, I'm going to be able to get out of this and roll this because this thing is still going to end up keeping some value, right? If I take a look at something above the money versus, let's take a look at something that's expiring next week. Look at what ends up happening to 13s, right? The 13s are still worth 35 cents here, whereas if I take a look at them out here, they're 55 cents. And what I did was that I'd sell something here that was, say, 20 cents, and that's now down to a nickel. So I have my theta, and I'll just show you real quick. Take a look at the theta here. It's -1.5 versus if I am buying the first nickel that I could at here, and I'll even say that maybe you could buy this one at a nickel. Okay. 77. Now, granted, okay, how much risk am I using? Right, I'm using $10 there, so I would have to end up using. It would be 6 of these things, right? 60 cents versus if I put the same amount of money in. I'm saying, okay. So look at my theta here. It's -4.6 versus my theta here is minus 1.5. And so what would end up happening is that I could actually end up buying more of these that end up helping me. And so your theta doesn't end up killing you as bad. Now, if you are truly just insuring against the end of the world, yes, buying a 35 call, okay, would end up working. But
Yeah,
if
that's really all he's doing.
okay,
He writes it off, you know.
yeah, it won't pay off unless what I'd hate to end up seeing is I hate to end up seeing that the VIX go up to 25, and his trade go from a nickel to 20 cents, and not make nearly what he thought he was going to end up making.
Mhm.
So
Yeah, he
If,
rolled
if,
him.
yeah, if you're insuring
Down the
against
road.
the end of the world, I think there are better things to buy than options on volatility.
yeah, I like Warren Buffett saying, he says, I love selling insurance against the end of the world because it can only happen once, and then who's going to be around to collect anyway?
Right.
I'm going to run over and see what James Hogan's talking about.
Okay, guys. Anything else? Paul or
No, I think I'm good. I just like this. We just stopped going up. It's kind of nice.
Yeah.
Get a breather.
See you guys.
Take
Yeah.
care. Thank you, everyone.